right, so should we call to order at 8:30?
Yeah.
We are all here. Terrific, good morning. Any members of the public? Does not appear. No, okay. Where did my agenda go? Great. So first on the agenda is approval of the minutes. Actually, I'd like to officially welcome our newest board member, Mike Palladino. Thank you so much for joining us. And you know, your reputation precedes you because we are thrilled to have you independently, but to have any continuing connection to our soon-to-be former administrator is another plus. So thank you.
That's good. I'm gaining her at home, so
Well,
I'm the lucky.
I appreciate the give back that you're doing. So thank you.
Thank you.
And well, and so first on the agenda is approval of the minutes. I guess we need a motion. Sorry, I'm a little flustered this morning. I think we need a motion. Thank you. Second?
I have a question. Do we need a second before we approve?
Well, yeah, usually we second and then we have a discussion if anybody has any comments.
Okay, I will second.
Great. And any comments? Did you have a comment as well?
Well, I don't know. This is a minor point, but do the minutes need to be modified to include the response to Lorraine's question on the market value of the 457B plan that Becky had provided us? Remember, we questioned the decrease in market value and Becky came back and said it was due to withdrawals. Is that worth modifying the minutes or not?
I don't think technically it's a minute modification because it occurred after the meeting concluded.
Yes.
So what we could do is note in the meeting minutes this time that we, after the last meeting, we did look into whatever it is we looked into and
Yes.
got the answer that we needed.
Great.
We brought a little more context.
Yes. Christy, can I send you or resend you the email from Becky, which provided
Yeah.
the response
I
to?
probably have, but just resend it like kind of
Will
like
do.
a reminder.
Yep.
Thank you very much for that. Any other discussion on the minutes before we move to approve? Not having, all in favor of approving the minutes?
Aye.
Sorry.
Aye.
Aye.
Anybody opposed or abstaining? Okay, I think the minutes are approved. Thank you. Back to our agenda. I believe is the report on benefits. Well, I'm getting my screen.
Yeah, usually.
Thank you, thank you. Takes a village. Yes, pension liaison report.
Good morning.
Good morning.
Good morning, welcome. Very nice to meet you in person. So this is the payroll pension retirement status report. As of May 1st, the town PD and Board of Ed had 98 retirees with a gross payroll of $176,404 plus one QDRO spouse for 99 total participants, no changes. Fire department had 41 retirees with a gross payroll of $17,304.62 plus one QDRO spouse for 42 total participants, also no changes. The one pending retirement or pending change that is forthcoming is Miss Leanne Palladino, whose pension will begin on September 1st. So that is the only change that I'm aware of at this point. Current figures for active employees as of the end of April. The defined benefit pension plan has 26 contributing police officers and 20 contributing town employees, which will decline to 19 very soon. And 18 contributing Board of Ed employees for a total of 64 participants. The defined contribution 401 retirement plan has 48 contributing town employees and 33 Board of Ed employees for a total of 81 active employees. The total plan balance as of the end of April was $3,177,825, which was an increase of a little over 200,000 since the prior month. So that's nice to see. The town's 457 plan has 90 active employees with a total plan balance of $5,376,149, which has also seen a bit of an increase of 359,000 since the prior month. 78% of our DC participants have elected the additional employer match, and that's 88% for the town and 64% for the Board of Ed, but 78% in total. Anybody have any questions?
Well, thank you very much.
Okay, so now we have the healthcare program update from Brown and Brown. Hi, Chuck.
Morning, everybody.
Good morning.
Morning.
So this is something we've done, I don't know, every year, but every other year or so for the last several years. Leanne has asked us to come out and just give everybody an update on where we stand for all the various health insurance benefits that the town offers to employees. So I have a presentation to share here. Yes. Everybody should be seeing that. All right. So a little bit of background before dive into all of the benefits. I'm Chuck Petruccione with Brown and Brown Insurance. We have been serving as the health insurance brokers for the town for, I want to say, close to 15 years now. I think it was around 2012 that we were first hired. And honestly, Old Saybrook is one of the best groups I have. We represent about 50 to 60 different towns and boards across the state of Connecticut. And for anybody who reads the papers or talks to your peers, you would know this year in particular has been a very, very, very challenging health insurance renewal year. The vast majority of our groups are seeing double-digit increases, and increases into the 20s are not unheard of. So the way Old Saybrook has performed has been excellent, and we're going to go through that now. So give a quick overview of everything that the town has to offer for employees, talk about the cost action, the renewal rates that will be occurring for each line of coverage, give a summary of the collective bargaining units as well. Medical is with Anthem and has been since 2020. Dental has been with Anthem for even longer than that. Vision also moved to Anthem in 2020. And the life and disability coverage that the town has was with Anthem Life a couple of years ago. That business got sold to the Standard. So I'll talk about that as well. So on the medical side of things, as I said, you guys are with Anthem Blue Cross Blue Shield. The rates for this coming year, as of July 1st, are seeing a 6.5% increase. This might actually be the lowest increase I have of any of my groups across the state. As I said, the town has performed well and has really worked hard during negotiations to keep the plan designs very modern. A lot of public sector groups get stuck in ruts and don't negotiate all that many plan changes throughout the years. That has not been the case here. Carl and Leanne have done a great job of negotiating, benefit changes to keep Old Saybrook ahead of the curve. So, yeah.
I'm sorry for interrupting, but will you just remind us who is in the purchasing block?
So it's actually it's evolving quite a bit this year. So the background on that, so as it says here, in 2020, prior to 2020, we had about a dozen groups that were buying medical insurance through Connecticut. And Connecticut was a fantastic partner, great coverage, gave very reasonable renewals year after year. And like I said, we had about a dozen groups that were happily renewing with them year after year. In the fall of 2019, we saw that all of our Connecticut groups' claims started to spike up. And, a group can have a bad year, right? That happens. A few groups can have a bad year. That happens. When all 12 were going up at the exact same time, we said, this isn't a group problem. This is a Connecticut problem. We confronted them on that, had many meetings with their underwriters. And at the end of the day, they said, no, it's just a bad year. And we're like, well, that's not really how things tend to work. So did a full marketing, and Anthem ended up being the most aggressive offer for everybody. So at that time, and at what really has been the case for the last 5 or 6 years, we've got the town of Old Saybrook. I know Naugatuck Borough and Board of Ed, Darien Public Schools, Stratford Public Schools, Lisbon Town and Board, Winchester Town and Board. It's all over the state, right? We represent a wide swath of groups from pretty much all four corners of the state. And there's been about 12 or 14 groups that we had brought in together to purchase things. During that time, we had negotiated a lot of multi-year arrangements with Anthem. So when we first came in 2020, we had a cap for year 2. We even had a cap for year 3. We outperformed those caps. Renewal stayed, as you can see here, single digits for the town in particular here, the entire time up until last year when we finally had an 11.8% increase. During this whole time, the market average has been about 8% on medical and 12 to 14 on pharmacy. So your average groups around the state have been seeing, a 10, 11% overall increase that during this time, when the town's increases have been mid-single digits. So the block in particular has worked out really well for the town. All of those caps, right, and those multi-year agreements we had were all in place. And then last year, the 7/1/25 renewal was the last time that we had, a cap in place. So as we were coming into the 7/1/26 renewal, we knew it was going to be a big year. Things were going to shift. So we had some groups whose claims had started to rise. And so different changes have occurred now within the block, and the dust is just kind of settling now on what the new iteration of the block is going to look like moving forward as of 7/1/26. We have some groups, some of the larger groups that were in there that have chosen to flip their funding model from fully insured to self-funded. So they're leaving the block. We have others, like I said, whose claims really rose so high that they were going to be facing. I mean, we legitimately had groups that were looking at 40% increases to their rates. So some of those groups leaving the block entirely and going to the state partnership plan. Really trying to work and find, like running groups that are performing well and can help each other out, which has been the case for the last 6 years. And now we're kind of reconfiguring that block moving forward. But the town really has been the best of the bunch. So as reflected in their renewal increases this whole time. So that's kind of the history on the medical. Dental, as I said, has been with Anthem for many, many years, long before 2020, in a self-funded arrangement. A lot of groups, a lot of public sector groups sometimes are leery about self-funding because there is risk, right? To give a little background for those who might not be familiar, it's kind of 2 basic ways you can provide insurance. Fully insured, like you guys are for medical. You pay the carrier a guaranteed premium each month, and that is your liability. The carrier then is the one responsible for paying claims. So if you have a good year, they make out. If you have a bad year, they're the ones bearing the additional risk. With medical self-funding, that can be a very volatile thing. You don't really want to be a self-funded medical group until you've got at least 300 is kind of the cutoff, but 300, 400, 500 employees, as you get that large, self-funding makes sense, right? There's money to be saved in the long run. A smaller group like the town here, who's only got about 50 or so employees on the plan, self-funding medical would be very, very risky. Dental, on the other hand, though, does not fluctuate, right? With medical, you could get a new person who all of a sudden gets a rare disease and becomes a $500,000 claimant. Or somebody's kid gets sick and starts taking a medication that costs 6 figures. There's no such thing like that on dental. Dental is going to be very, very consistent year over year, and purchasing dental on a self-funded basis is absolutely the way to go. So town's been doing that for years and years. We did see a little volatility around COVID, right? COVID hit in 2020. People stopped going to the dentist. So dental claims went down at that time. After that, we then saw a spike for a couple reasons. One, people started going back to the dentist in general, getting their cleanings and all their routine care. But also then things that they had ignored for the last year and a half while they weren't going to the dentist during COVID had to be addressed. So we did see a spike at that time, but those claims have now settled and we're back into a more standard, non-fluctuating dental claim situation. Last year, we did see a 5% increase in Anthem's monthly administrative fee for running the plan, but that was guaranteed for 24 months. So we are still in the middle of that contract and there's no increase to the fee for this year. On the vision side of things, we do have a vision plan that is included. So anybody who has medical automatically gets the vision plan from Anthem. Again, no increase to that rate for this year. When the block was created in 2020, we had a multi-year lock-in on those rates. Got another 0% increase at that time that brought us up to this year. And Anthem, again, no increase on the rates this year, and they're good for another 2 years. So vision rates unchanged through July 1st, 2028 at least.
Actually, excuse me, Chuck, before you leave the
Yeah.
medical type coverages, could you tell us what the coverage for the insured is? Is it 100%? Is it 75%?
So that's actually going to be on the very next slide.
Oh,
So,
go ahead. Okay.
Yep, we're good. All right, so last basic coverage here for the town, life and disability. We are currently, as I said up front, with the standard. So this was a line of coverage that had been a little problematic for us several years ago. The town many years ago was with the Hartford for life insurance. And prior to us joining the picture, the town used to purchase life insurance in conjunction with the Board of Ed. The board separated from that, and the town was allowed to retain those rates for the remainder of that contract. When that contract expired, the Hartford was looking for a massive increase because, again, it's a smaller pool of people, and the town has a fair amount of retirees that are covered on the life insurance, which, is a risky proposition life insurance wise. So we were facing a very large increase, ended up marketing it, and after bouncing around to a couple of different life insurance carriers over the years, in conjunction with that move to Anthem for medical in 2020, we got a good deal with the life insurance. So we actually got a decrease to the rate back in 2020. Kept those rates for 3 years. And then in 2023, we actually negotiated a decrease as well as an enhanced benefit. So this was something that in our work, again, with all the towns and boards we represent, we have a good outlook on what the pain points are for a lot of groups. And in the public sector in particular, this is more of a Board of Ed thing, but it does affect towns to some extent. Groups tend to approve leaves, like leaves of absence, at a higher rate than you would see maybe in the private sector. So your standard life insurance coverage says, all right, active employees are covered. Now, not retirees, right? They're their own bucket. But for active employees, they're on your plan and they are covered while they're actively working. If someone were to go out on a leave, a standard life insurance policy says you can keep them on for 3 months. Once they've been out for 3 months, then they no longer have coverage. Well, that doesn't really work great for our public sector groups who frequently approve leaves of absence of a year or sometimes more. We have issues of workers' comp, right? People might be out for much longer than 3 months. So in 23, in addition to negotiating the rate decrease, we actually got language into our life insurance contracts that allow people to remain covered on a group plan for up to 2 years while out on leave, which is a lot better coverage and fits a lot better for our public sector groups. So renewed as is in 23 with that. And then in 2024, Anthem sold their entire book of life insurance business to the Standard. So we are now with the Standard for that entire book, including the town here. And for that renewal, which was due up for this July 1st, we once again leveraged the very large book we have there and negotiated another 5% rate decrease. And that is locked in for another 3 years. So we are good through at least 7/1/29 on these rates.
And this disability is accidental death and
Yeah.
dismemberment.
Correct. It's not a long-term disability, not short-term disability. This is just AD&D, right? So if someone passes away as the result of an accident, essentially the policy pays out double. All right. So what are the benefit coverages that we have in place? So these are our medical coverages as outlined in the various collective bargaining agreements. We are pretty much aligned. Most of our groups are in the exact same plan with a few minor differences now. These are traditional high deductible health plans like you would see in the vast majority of the market these days. All of the collective bargaining units have a $2,500 deductible as a single or a $5,000 deductible as a family. All medical services after you satisfy your deductible are covered at 100%. Prescriptions after deductible then revert to a copay. You can see in most cases it's $5 for generic, $20 for tier 2, $35 for tier 3. The dispatcher's contract is slightly different, and then non-union not being in a contract, theirs is slightly different as well. We have also, you see the note, have negotiated again over the years to put some prior authorization in on things like high cost imaging. And the town has also moved to Anthem's Essential RX formulary. So little background on that. Anthem has a couple of different drug formularies or the list of drugs that they cover for members. Their standard is the national formulary. That's their largest list of medications that they cover. The essential formulary narrows that down by about 15%. So where the cuts are made on that list is Anthem says, hey, we're not eliminating coverage for any particular class of drugs, but there are certain medications that, hey, there's 2 or 3 drugs that do the exact same thing, and we can get better pricing on these ones. So we're going to skim off the more expensive versions of the price and then steer people toward the medications we get better pricing on. If someone clinically needs something, there is still an authorization process and that can be approved for them. The biggest example of that, whenever we have a group that's looking at a move from the national formulary to the essential, is name brand Synthroid. Very popular thyroid medication that a lot of people take. On the national formulary, it covers the name brand version. On the essential formulary, it does not cover the name brand version. It only covers the generic. 9 out of 10 people are perfectly fine taking the generic, and they make that move, and it's not a problem. If there is a situation where someone is allergic to the ingredients in there or tried it and it wasn't effective for them in the past, their doctor can speak with Anthem and get that taken care of. So that's kind of the high level of the various medical programs. Did you guys have any particular questions on these? Then the last thing I had was a note of something that we did have to change for this calendar year. So for many years, the town has offered a Medicare plan for retirees. And, you know, the retiree takes Medicare Part A and Medicare Part B. And then the town has had a supplemental or an advantage plan in the past to offer coverage for that. That had been with Connecticut going back to at least 2019. And unfortunately, there's been a lot of changes with the Medicare market at the federal level. So the way Medicare Advantage plans work, which again is what the town has had for the last 7 years, a Medicare Advantage plan is actually an insurance carrier taking over the full Medicare coverage and fully insuring that person's plan. So Medicare supplemental plans, let me back up because there's a distinction that I need to make so everybody understands what we're talking about. When you have a Medicare supplemental plan, you still use your federal Medicare card. That's your A and B coverage. And that generally covers the first 80% of services under Medicare. Your supplemental plan, then you have a separate ID card, and that picks up the last 20%. That's very simple explanation of how an old supplemental plan works. The Advantage plan, the carrier now says, hey, wait, you don't need your federal card anymore. We're taking over the whole thing. You only need one ID card. They cover 100% of the claim. In exchange for that, they get a subsidy from the government for taking over, for the government no longer being responsible for the insurance coverage. Well, what's happened over the last couple of years is the federal government has cracked down and has reduced those subsidies for a lot of these Advantage plans. So the costs have been increasing, right? Carriers are now on the hook for more claim, not getting as much subsidy from the government. So that has, one, led to price increases, but two, led to a lot of carriers just getting out of the market entirely. So Anthem actually used to offer a ton of Medicare supplemental plans in the state. They made a decision 2 years ago. They don't do that anymore unless you have 50 or more. Well, we have tons and tons and tons of groups that only cover 5 retirees, right? It's just a small handful of people. And so they left the market. United Healthcare left the market here in Connecticut. Connecticut followed suit, and they chose to leave the Medicare market for our groups here in 2026. So we had to search around, and we found a plan that matched the plan that we had with Connecticut as closely as possible. For those who are familiar with the letter versions of the Medicare offerings, the Cadillac plan offering was always Plan F. The Plan F plan was a Medicare supplemental plan that member had no out-of-pocket expenses at all. Well, a few years ago, the federal government said, you can't offer those anymore. Groups that have them can be grandfathered in, but no more new groups can offer Plan F. So now the best available supplemental plan is a Plan G. It is identical to Plan F in all ways, except that the member does have to pay the annual Part B deductible. So here in 2026, that's $257. So that's literally for the entire year, that's the deductible.
283.
Yeah.
Chuck, can you hear that?
I'm here.
I think the deductible, Plan B deductible that you're showing is 2025.
Oh, okay.
It's 283.
Okay, sorry about that. But that is the only piece of the plan that employees or retirees would have to pay on the medical side. On the prescription side, there is a retiree RX care rider for prescriptions, and that mirrored what we had in place with Connecticut previously, which was $10 for generic, $25 for tier 2, and $40 for tier 3. So as close a match as possible to what we had before. And from a rate standpoint, last year with Connecticut, we were paying $534 a month. And now this year in this plan that's coordinated by Amwins, we're paying $564 a month. So not too large of an increase in the grand scheme of things, especially considering our hands were tied and we were forced to make a change. So that's really kind of the only change per se that I would say has occurred with the town's benefits here for 2026.
Leanne, did your office hear any pushback from changing from a Medicare Advantage plan to a Medicare supplement plan for retirees?
We had like 2 people that balked at the $250 or $283, and that was it, because they said that they didn't have to pay that before, and we explained. And we looked through all the contracts with the lawyers and everything, and it said substantial, and actually the contract said that we will offer a supplemental plan, not an advantage plan. So, we just said, hey, that's what's going on, and that's the best we can do, and it went away.
Good.
That was everything that I had pre-planned, but I'm certainly happy to answer any questions anybody may have.
Chuck, are the folks in the purchasing block, do they have a high deductible plan too, for the most part?
Oh yeah, yep. It's standard. Like I said, the plans you guys have are absolutely industry standard. If anything, you guys are slightly ahead of the curve, like I said, with the vast majority of your employees being in a 25.5 deductible. We still see a fair amount of 2,000, 4,000 deductibles across the rest of the public sector. But, all those other groups are catching up now. 2250, 4500s are pretty common, and with groups moving toward 2,500, 5,000, and we actually do have a handful now that have moved up to 3,000, 6,000. So it's that is where the market is headed.
Chuck, it's Leland McKenna. I was listening to the first part of the presentation on the phone. Now I'm in the room. Just a quick question for you in terms of the public sector, in particular towns being able to kind of come together to get more covered lives. There was a lot of movement or a lot of noise around the public option for next year and studies and also association plans. But can you just speak to going back, I guess, 10 years, how towns were allowed to come together and pool their lives and where that might go with all the noise this year and potentially next year?
Yep. So
Okay.
the history on that is it's actually 2010. So we're 16 years now since it's been legal in the state for towns and boards who have no other business together to purchase insurance. Somebody like a regional school district, right? Because they have other business, they've been able to purchase insurance together for years and years and years, even long before 2010. But an arrangement, of towns and boards who have no other business together to be able to purchase health insurance, that started in 2010 when there was a law change for that. Actually, what we're doing right now doesn't fall under that because the arrangement that we have with Anthem is not really formal, right? You guys don't have bylaws. There's nothing that's requiring groups to stay together. It has worked because it has made sense, right? By Anthem looking at collectively a dozen groups together with 5,000, 6,000 lives, from an underwriting standpoint, they can say, all right, we're looking at this and we're spreading that risk across all these groups. So when we looked at things this year, essentially what we were able to accomplish was everybody got about a 5% lower medical increase than they would have gotten on their own. But there's not a formal document that pulls everybody together like we do have some other collaboratives and consortiums that are formally together. They have bylaws. When you join, it's a 3-year minimum, right? There's all these rules. We don't have any of that here. This is an informal purchasing arrangement that has just benefited everybody because we're kind of buying in bulk. But it doesn't. The law part doesn't really affect us here.
Got it. And they tell us who the other towns are because they know.
No, it's coordinated by us, right? So these are all of our clients at Brown and Brown. Yeah.
Thank you.
Yeah.
Any other questions? It's great to have so many health insurance professionals on board.
The only thing that I'll say, and it doesn't really affect this board, but there's 3 things that Medicare Advantage plans do when the government cuts off their subsidy. Chuck named 2 of them. One is they make everyone pay more. 2, they'll leave the market. The third thing that they do is they just stop paying hospitals and providers less. So that's the third thing that they do. Doesn't affect our anyone that we have. It just affects the providers in the market. But the insurance companies will find a way to stay whole. It's the rest of the world that.
And I had a question just in terms of the employee benefit. Does the town pay 100% of the premium, or is that shared with any of the employee groups?
It varies based on the employee when they retired. Some we do, very few, the older people. And then when they retire, we've changed the language in the contracts now to say, whatever that union is doing, you will do. So, you know, if your co-pay is 15%, it goes up to 16, they'll have to do that too. So.
And then across the various negotiating groups, what do we do? What do we fund? What percentage do we typically?
Typically somewhere between 15 and 17%.
If the employee pays.
The employee pays that portion of the premium. It's a little bit different with the retirees because their premium is different, but it's still 17 or 16% of whatever their premium is.
And either the benefits or that cost share, is that a subject of the bargaining that's going on currently? Is that something that they really focus on?
Oh, yeah, that's one of the primary salary and benefits.
Well,
And Carl
insurance.
handles all of that, and he's done a fabulous job. He gets 100% credit for all the money and the negotiating. And of course, Brown and Brown then takes the ball and makes sure we get the best price for it. So.
Well, I always listen to these presentations and compare it to my small employer purchasing power, and the town has much better coverage and rates than we do. So that's great.
Really do.
I think one of the most important things that the town does is manage the formulary. There's a lot of money to be saved by managing that formulary. The risk with the town's plan now is that Anthem is managing, right? Anthem is the insurance company and also managing the formula. So they're they're gonna tier their drugs with what makes them the most money, not what costs the town's employees. So that's one thing to keep in mind as we move forward is there a benefit to having kind of a third party look at our formulary and see if there's any money to be saved? And we do that at the hospital. So forever we were an Aetna shop. We're self-insured, but we were an Aetna shop and we had CVS Caremark. Well, Aetna owns CVS. And so we brought a third party into the hospital, look at our formulary, and they're like, no, you're spending a lot, your employees are spending a lot more money on drugs because CVS is directing them towards the drugs that make them money. So that's just one thing for this board to consider moving forward is, are there third parties that can analyze that formulary and truly make sure that what's costing our employees the least amount of money and not.
I would ask Chuck that question. Is that something that's in conflict with your arrangement with us? Or is that?
Not at your size, really. That's the problem, right? You've only got 50 people on the plan. So I had touched on self-funding versus fully insured. So like Leland said, you know, as a larger employer, there's all kinds of levers you can pull, right? You're self-funded, you can carve out your stop loss, you can carve out your prescription drug, your pharmacy benefit manager, lots of things you can do. You guys have 50 people on the plan. You're too small to be self-funded, which takes away a lot of those options that you could otherwise have.
Is that self-funding leave?
I mean, yes, we do it because we're
So
self-funded.
large, okay, all right. I guess that's why we haven't done it.
Yeah, so I think the takeaway is you can still look at the formulary and just ask, make sure that what Anthem, again, you don't have a lot of leverage, but it could at least let them know that we're paying attention to the formulary. And if the employee let's just say there's a chronic illness, an employee's gonna be taking this medication for the rest of their life. And Anthem says this is the cheapest option, make sure that that's the cheapest option. There might be a generic that, is less expensive for the town and the employee in the long run, especially if they chronic illness. But again, you don't have any leverage when you're not self-insured and there's only 50 people. All right, so I don't know if it'll get you anywhere.
We're always looking for every cent we can.
You can at least let them know that you know.
Yes, we will. Thank you.
Any other questions for Chuck? All right, well, thank you very much for that great presentation, Chuck. You're welcome.
Welcome, everybody.
Get going if you want to.
Okay. Have a good day.
Thank you. Bye-bye. Okay, on to Morgan Stanley.
Great, thank you so much. So yeah, a lot of massive moves over the last month that we can kind of talk about here. Where to start?
Yes. Would I get an extra copy of that?
Yes.
It's difficult for me to go back and forth on
Not
that
actually
screen.
worth two up there in a second.
Thank you.
If not, look on that.
Thank you. Yeah, I was gonna say,
Go across like that.
thank you.
And as well.
I wanna see you get her, thank you.
Guys.
Yeah.
For people, I can't see that part.
Ignore my eyes are starting. Files, so I'm getting better, at figuring out which file it's on.
Not doing as well as they once did.
So page 3, I mean, one of the things that sort of Morgan Stanley has bounced around about is the risks that are going on in the market. And we're calling this a FOMO market right now, fear of missing out. Okay. Because as I go through a lot of the slides here, you'll see that the factors that have done well are basically low quality, high beta, and momentum. Okay, and we had talked about this maybe about a year ago, going to the second half of last year. We saw the same type of market action, and that was one of the reasons that our mid cap managers did very, very poorly, and our small cap managers did very, very poorly. That's still unfortunately going on. There is a debate as to how much this oil situation is going to ultimately impact earnings in the latter half of this year. You can see, I think, on page 3, one thing is we've upped our base case from 7,800 to 8,300 on the S&P 500, which is going to be 23 times earnings, which is much higher than we've ever expected. Our inflation expectations have gone up from 2.5 to 3.5, and our 10-year yield end of year has gone from 4 to 4 to 4.25. Okay, the 30 year is over 5%. The 10 year is around 4.5%. The last time the 30 year was over 5%, it caused like this calamity in the equity markets. Everyone was really worried about long-term funding and everything. No one cares anymore. It's very interesting. The dollar, as you see, we had the first half being it down 6%, second half up 6%. Now we've decreased that range. That basically think the dollar is just going to continue to stay weak. Okay, and that's what we were expecting too. Again, price earnings multiples currently it's really closer to 22. If we get up to 8,300, it'll be closer to 23. If you just want to go to page 7. So we can kind of get into, what's been happening. So, we had this relative outperformance on the right-hand side of emerging markets and the equal weighted S&P 500 sort of in the beginning of the year. Basically, since the end of March, we've seen a complete reversal in a lot of these different factors. So tech now is doing well, again, momentum doing well, low quality doing well, value not doing as well, quality not doing as well, et cetera. But you can just see, I mean, just on the left-hand side, just from and again, earnings have been going up, but you can see just the parabolic kind of rise that we've had over the last, especially 2 to 3 years in the market. If you want to go to page 8. All right, the upper left-hand side kind of gives you a sense of like high beta stocks, higher volatility stocks, as you can see from May basically until now have risen very, very quickly. If you want to go to page 10, I think that's a better representation here. When we look at the equal weighted versus the market cap weighted S&P, you can see again from March, but from the beginning of October, equal weighted started to do better as the broadening of the market came out. That's all since reversed again since March. Upper right-hand side, you can see again, momentum and high beta are doing much better in terms of relative outperformance versus value and quality. All right, so quality balance sheets not in favor. So as a fiduciary, imagine if I came to you at the beginning of this year and said, let's get in the riskiest stocks with the worst balance sheets. I mean, you should fire me on the spot. Left-hand side, lower left-hand side shows the changes, okay, and all these things. You can see that high beta in the beginning of the year from January to March was down 5%. Now it's up almost 15. Value, okay, beginning of the year was up almost 10%. Now it's down 2. These things are changing very, very quickly. Very, very quickly. And it's gone from basically a market that we thought was going to broaden out to let's just do the same old thing. Overweight semiconductors, overweight technology, speculative stocks, get me the highest rate of return risk we can. I'm calling it's going from GARP, which is growth at a reasonable price, to GAP, which is growth at any price. So these are just the headwinds that we are facing in the market right now. Do you want to go to page 14?
Kev,
Yes.
before you move on. In the next few months, probably for sure this year, we're going to have 3 new issues, which are all $1 trillion market caps. And, Anthropic and OpenAI and SpaceX. The SpaceX will probably be first. I'm just wondering we do have some index funds that we do hold, S&P 500. So what's the impact going to be of these? I consider, I consider them to be unseasoned at this point. And all of a sudden, they're going to be one of the largest holdings or 3 of the largest holdings in the S&P 500. So would you just discuss that, what Morgan Stanley's views are?
That is a fantastic question. And the reason it's a fantastic question is because immediately these are going to be added to within short time, they're going to be added to the indexes. And as you said, it's going to basically take the risk weighting of a lot of the technology that we have, which is already 35% of the index, don't forget, all right, to a higher percentage than that, most likely. It's really going to depend on how it trades after they actually IPO, all right, because while everyone's expecting these things to do very, very well, and given the latest market movements, I would expect them to do well, regardless again of what the fundamentals are or what the valuations are. There are other situations where, for example, Meta, Facebook, when they IPO'd, okay, it actually traded down 50% to start and then had its rise after that. So it really depends on the price that everything kind of comes out at, but I think it's going to add to the risk of concentration, the index, without a doubt.
Right.
And to your point of it being unseasoned, these are unprecedented. This is unprecedented. We've never had $1 trillion IPOs before. I mean, it's like, that's literally just never happened. And we're going to have basically 3 of them. So I'm not sure how the market is going to digest that, but I think it's going to certainly add more concentration risk to the indices that we have that have already been over concentrated.
Is there any action we should be taking now or in the next several months to
see?
I'd be interested in what Morgan Stanley says.
Reducing our S&P 500.
You know.
Another great question. We've been reducing our S&P 500, index holdings, I say, to the detriment of the portfolio, and I'll go over, some of the reasons we're underperforming the benchmark in a little bit. So the issue becomes it's a damned if you do, damned if you don't. Because if we reduce our holdings further and these things go up, 20, 30, 40, 50, I have no idea what they're going to go up, then we're going to miss out on that performance. Yet if we start cutting it back and, we're reducing our tech holdings even further, if this trade continues, then that's going to, again, be a drag on our performance, right? So I think as long as we kind of understand that, and recognize that risk, and can digest the relative risk reward of doing that, then if the board's okay with that, we're certainly comfortable with that.
What are those IPOs?
We're not allowed to talk about one of them, just so you know, okay? But they'll be coming in the next month or so. Yeah.
The first one will be SpaceX. At the moment, that's what we're seeing. But
Have
you
people
never
been
know when
buying,
they're going to come.
have people been buying the index in anticipation of this
Say
issue
that's
themselves? So
part-
we've been reducing our exposure, and everybody's getting ready for this.
Getting ready for
Yeah.
being without having to participate, right?
Right, because they want to be in the pot when it, or whatever happens.
And I'll say just, again, not naming any specific deals or anything like that, but the interest has been pretty substantial. So I'm not sure how allocations are gonna go or what the frenzy is going to be in terms of these types of issues going forward.
I had a question as well on those momentum stocks.
Yeah.
And productivity. Is there a correlation between those stocks and the productivity gains that are underpinning parts of the market? Or is there a big differentiation between those and value stocks and productivity or?
Definitely, but AI is going to affect every part of the sector, right? So every part of the economic sectors in the S&P 500, right? So whether it's the, I don't know, restaurant and hotel industry, or if it's a retail firm, or obviously a software firm, AI is going to be a part of, all their infrastructure kind of going forward. I think where there's still a lot of debate is obviously where the productivity gains are going to come from. Right now, the productivity gains have just simply come from laying off physical human, capital, right? And replacing them with AI. That's not a productivity gain, that's an expense reduction, really. That's all that is. And there's different thoughts as to how that's going to unwind as sort of we go forward in the economy here. Like, is that how earnings growth is going to continue to happen just by laying off humans and replacing with AI? I mean, possibly. That's a dangerous cycle, because then we get into a point where employment gets too high. And people just can't afford the basic goods and services that underline the economic growth that we actually have. But that's like a philosophical, I think, debate that's sort of going on. Again, the productivity gains that have materialized have not justified the cost of AI as of yet. Okay, now there's other papers that say there are huge productivity boons because of AI and how efficient it is and how it makes our lives easier and can aggregate all this data and create presentations and do all this wonderful stuff, right? All I can say is that from looking at the inventions over time, okay, the thing that had the biggest productivity gain out of anything was the personal computer, okay? The iPhone had zero productivity gain to US GDP. Okay, and to the average human worker. You'd think that that would be a huge productivity gain, because now all of a sudden we're available 24/7. We can work mobile phones as opposed to go to the office. Had literally no effect. So will AI have some effect? Will it have no effect? Will it have, will it be a better search engine than Google or something like that? Yet to be determined. Yet to be determined. But I think there's a lot of obviously optimism about what AI can deliver. Okay, but I think it's more as to what you can deliver to the bottom line earnings growth of these companies, rather than productivity gains from human capital, right?
Okay, thank you.
Any other questions? I mean, maybe actually we should, just look on page 16. It's kind of a point when I was looking at page 17. This sort of shows you the expectations here, right? So we're expecting operating margins to increase by 20% due to AI, basically. But again, that's not necessarily productivity, that's just margins. So those are different kind of things, right? But the productivity in terms of return on assets, for example, or return on equity for each of the companies should increase because of the AI implementation. If you want to go to page 17, though, just kind of back to expectations, what's been happening in this year. The contribution to S&P 500 earnings growth, okay, this is just wild, right? Micron is a third of the S&P 500 earnings growth. One company has really been responsible for a third of earnings growth in Q1. Just again, unprecedented. Page 20. We're talking ad nauseam about valuations. Again, you can see sort of just in terms of lower right-hand side, anytime we get around 22, there seems to be some sort of at least, short-term or maybe a longer-term correction. As you can see, we've really raised up the average PE ratio from around 16, times to around to at least 20 times, from 2020 onward. I think that, we've talked about the equity risk premium ad nauseam and how it's basically been flat. It's been flat for 3+ years now, so I don't want to get to that too much, but the chart I find interesting here is the lower left-hand side, which just shows that, the 22 times and the 24 times earnings are actually off the chart. They're not even here on the chart. So if you look at all the other, kind of valuations, whether it's 20 times, 18 times, obviously there's a little bit of downward pressure that you could see depending again on the earnings growth and and the ability to meet those earnings growth expectations, within the S&P 500. Page 21 shows how fast we've just had this recovery, right? So war's still going on. Okay, I just want to be very, very clear about that. Strait is still closed. There's some deals going on between China and Iran to let some of the Chinese vessels through. There's talk about Iran having a toll now for a lot of the oil vessels to go through. All this is kind of hyperbole and speculation, but I just find that there's if you remember back to 2022, okay, beginning of 2022, and then 2026, there's a lot of parallels, okay? 2022, we had Russia, Ukraine. Okay, and everyone got very, very worried about that and how geopolitically that was going to sort of affect global earnings growth, right? More natural gas, because natural gas pipelines going from Ukraine, especially to developed Europe, than oil than we have now, right? But we have the Iran conflict now, we have oil rather than gas. Inflation was very, very high. And in 2022, inflation is certainly ticking up, and we expect it to tick up higher. And then you had a hawkish Fed, right? So you had a Fed that was raising rates. Now you have a Fed that instead of cutting rates is more likely to raise rates going forward. So it's very, very similar, yet the market action in 2022 was a little more, not panic, but a little more concerned about, near-term growth in GDP. And now it's kind of an afterthought, I would say. Page 29. Again, this is CPI. You can see, left-hand side and PPI. Headline PPI is up to 6%. Okay, it's the highest it's been since basically beginning of 2023, end of 2022. CPI you can see is ticking up. Page 31. I want to get into lower on the right-hand side. This is gets into the crude price and things like that. So this is the millions of barrels per day impact to crude oil production because of the war. It's around 4 million barrels per day. It's actually a little higher than that in terms of just the supply that can't get through the strait. But if you just look up ahead at the times that have had a worse impact to the crude oil production, most of them were in the late 70s, 80s during the oil embargo. And then 1990 Iraq-Kuwait war, which there was a recession in 91.
That was the shortest one.
So very, very interesting again that we're basically at a historical precedent that showed that inflation ticked up higher, growth ticked lower in basically every one of these situations. But we're still expecting growth to be, or at least the market is expecting growth to be pretty robust. And then page 35. Rates are up. Okay, rates are not down, rates are up. We have 10-year treasury again, it's about 4.50 today, 30 years just over 5. Japanese bond yields are up, euro sovereign yields are all up, so yields are up all across the curve. And then on page 36, right-hand side, basically the real Fed funds rate, has decreased below zero. And when this happens, that generally means that we have a little bit more volatility in the market, whether it's 3, 6, 12 months afterwards. So we're expecting again more volatility going forward. There was some volatility. Now we're, again at extreme levels. But that's all I have in terms of the concerns. Okay. That being said, the things that are outweighing that is just, AI is going to lead to this giant productivity boom, and that's going to create earnings growth, and earnings growth is more important than valuation right now in terms of what the market is saying. Just want to go to the performance.
Can I just ask a quick
Yes.
question, Ray? So, Barbara manages I'm gonna ask a question for you.
You go right ahead.
Our cash, should we be locking in longer term now, or? Yeah,
Yeah, that's a good question. There's a argument to be made about that a few years ago when the 10-year went to 4.5, right?
we only go up to 3
Yeah,
years at the most.
Exactly. So I would say, going out, 2, 3 years, not bad, because the yield curve is actually steepening a little bit more, right? The shorter term rates have gone down in the last year. 10 years gone up about 40 basis points. So getting, still shorter duration, but a little bit higher yield pickup wouldn't be, the worst idea. I wouldn't be super aggressive about it now, but because if the Fed does have to increase rates, then you'll certainly see that adjustment in the 1 to 2 year kind of treasury.
Yeah, we're gonna buy something tomorrow.
Okay. What duration, or
That's why I want to discuss with Leanne as to what fiscal year we want to go into, so I don't know yet.
I mean, you hold to maturity, so as
We
long
always
as you're
hold to
holding
maturity.
maturity, then, again, it's the kind of thing that we have in
We
the,
just go 18 months.
well, in the short term, it's just like having in our short-term
Something.
corporate bond ladder that we have for the
Right.
pension, right?
That's what we
Is we
do.
just hold to maturity, and then if we get a rate pickup, then you just roll that into the next,
Right.
the next maturity that has a higher rate.
Yeah.
So, yeah,
The short-term rates are not bad.
they're not, but they're not as good as they were a year ago, unfortunately. But,
No.
yeah,
Nothing.
no, that was another good question.
Yeah.
All right, so I just want to go to page 4 on the performance. So for the fiscal year, return net of fees up 874. As of last night, we're up 1036 for the fiscal year, so it's still another strong fiscal year. But underperforming the benchmarks, okay? And I would just say, I want to be very frank, it's been super disappointing. And the reason it's been disappointing is because I believe Becky and I have gotten on some of the macro kind of calls in the right direction. And the implementation has just been not what we expected. So for example, staying short duration fixed income rather than increasing duration. The effective duration of the bond portfolio is still under 3 years. We got that right, and the managers have actually done okay there, right? We've talked for years and years and years about our overweight in international and emerging markets, right? Emerging markets are up over 2,000 basis points versus the S&P 500 in the last 12 months, okay? Our manager is underperforming, right? And that's because they have been underweight Latin America, which has done very, very well. International was up 900 basis points to start the year. Now it's basically flat. And our manager is not doing well because they're underweight in Japan. Value was up 500 basis points just 2 months ago. Now it's down 200 basis points to growth. So we've been positioned in this thing that was working, and now all of a sudden it's not. And we've decided to be overweight in these asset classes that we feel like would be contributors to the portfolio. And while they've contributed, they haven't contributed to the effect that they probably should have, especially in emerging markets and international. So I just want to acknowledge that and say that, the international emerging managers are basically on watch right now, and we're going to evaluate replacing them. And a lot of it's just due to their geographic diversification has not been helping them at all. They've probably been too concentrated in the areas that are lagging, less concentrated in the areas that obviously are leading, right? So even if we had a broadening out of, let's just say, an equal weighted geographic diversification of international or emerging markets, I feel like we would have done much better. That being said, 1036, you're going to be ahead of the actuarial assumed rate of return. You're going to have some gains that are going to be able to be, you know, used for prior years in the 5-year amortization. So still doing okay from a assumed rate of return perspective. And then also, if you want to go to page 5, you know, we're obviously on the lower risk, lower return spectrum, but we are, you know, 1 turn of standard deviation lower than the benchmark and the 60/40 S&P 500. So, you know, we are actually taking less risk. The problem is we're getting a lot less return. And that's been frustrating for us. Income is still around $700,000, you know, expected for the year. And with interest rates increasing, we'd expect that again to continue to increase. So in terms of the net, basically $1 million that we have to pay out a year, which we did in January, and we'll do probably again at the beginning of next year, you know, we're getting a majority of that from cash flow, right?
Yeah.
So we don't have to sell a lot of principal to do that. So that'll allow us to not have the principal be encumbered and allow it to grow with the market and recover with the market, even with those pension payments. If you just want to go to, I think we can just go straight to page 12. Just our overweights and underweights. You can see we're slightly overweight large cap, but more on the value side. Slightly overweight small cap, overweight developed international, overweight short term, overweight emerging markets. We've gone to an underweight in high yield bonds. High yield has done a little bit better after the headlines about private credit and things like that. There again, there's the debate is still out there on whether there's going to be a private credit cycle or issue with some of these issuers. I think that the more near-term issuers are going to have probably more susceptibility to a credit event than some of the more seasoned ones. But again, we don't think that the extra risk that the extra yield giving a high yield is worth the risk right now because spreads are continue to be pretty tight. If you want to go to page 15. So, you know, start with what's worked. Davis has been fantastic, 23%. You know, that's the value manager that actually has done very well versus a benchmark. You know, some of the fixed income managers, we go to just to page 16 and kind of get into, you know, staying short term again for the fiscal year, the short term corporate bond ladder, which is the third manager down, short term fixed income up 354 for the fiscal year versus the intermediate maturity manager was up 279. High yields up, you know, 418, but lagging their benchmark a little bit. And then when you just kind of go down the line, you can see obviously that, you know, mid cap has done very poorly the last 12 months, a little bit better on a month to date. And then Schroders International Alpha, you know, underperforming by 1,200 basis points, as we kind of talked about. And Lazard, even though it's up 30%, you know, underperforming its benchmark by 1,600 basis points. So very disappointed there. Slightly positive, John Hancock had a great month, you know, outperforming their benchmark by about 90 basis points. So we feel like, you know, they've been in a part of the market that's been very beneficial. They certainly have more high quality tech, some financials. That's basically like the core of their exposure that have both done very well in this latest rally. Any questions?
So I'm just not clear as to what the current strategy is. I thought we were getting away from the S&P 500, but now are you suggesting we go back toward it?
No, I'm not suggesting any. The only changes I'm suggesting are possibly replacing the international managers right now. The S&P 500 exposure, just go back to page 15. You know, it's about 3.7% of the portfolio, right? So it's a very, you know, marginal position. Not overweight. We're certainly overweight quality. We're certainly overweight, you know, good balance sheets. We're certainly overweight geographic diversification, right? So in terms of, you know, reducing our risk, like bring that to 2% or bring that to 3% or whatever it may be, but I feel like it'll have a pretty, you know, marginal or negatable, I should say, impact. But something that, we want to, be mindful of, because back, I'd say that this was probably, 2 years ago, twice as much in the portfolio, and we've been reducing it as the tech exposure has gotten to 30 to 35%, right?
And I thought, I try to stay out of all these investment decisions because that's not my lane, but Paul usually is trying to compare to the S&P 500 and noting that we are not performing as well as it is. And I thought that Paul's question was, are we missing the market now?
So,
Am I?
no, I think Paul's question was more of like with these, unproven tech company IPOs that are gonna go into the
Yeah.
market. What sort of risks do we have to be aware of?
That was really that is at the moment, my principal concern and what the impact would be on the index funds, but also on the market in general. It's these are huge companies in terms of market cap. And the idea that they're relatively new companies, I think will substantially increase the risk profile of the holdings that include them. So it makes me a little bit. I hold S&P 500 myself, and I have the QQQs and so on. So I'm sitting there with those holdings, but wondering what the impact will be. And relative to some of the performance relative to some of the managers, and we've discussed that the mid cap is disappointing, but there are others where you look at the index funds and wonder why we pay the managers fees.
Yeah, no, I understand.
No, it's true. I mean, that's
Yeah.
it's the way it is.
Oh, thank you for that.
And then I just want to point out, go to page 18. So, I think we sort of like bypassed the IPS review last month. But we do have two suggestions in terms of just being more specific for the indices and some of the language in the IPS. So the first thing is, in the IPS, we still have the fixed income benchmarks as the Barclays aggregate bond index, because that's how it was always known as. And now it's just called the Bloomberg aggregate bond, US aggregate bond index. So we just need to make a nomenclature sort of change there. And then next thing in terms of on page 13, we talk about state laws and regulations. I think just again, to be more specific, we should just say, Connecticut state statutes and requirements. Obviously, all Saybrook is in Connecticut, just makes it more specific. That's all. These two things are just really I think, minor changes to add specificity to the.
So moved.
And are we in a position to make that change mid-year? We usually do the review like once a year.
Yeah, I think I forgot to do that. Usually Kevin and I get together. So you know what we'll do is for the next meeting, I'll put forth. Usually we see the track changes and everything, and then it's so easy you can vote on it June.
So we'll put this into
June.
this change into the IPS. We'll see at the next meeting.
Yes. Yep.
Great. Thank you.
Perfect. And then just on the fire, same situations, but just wanted to highlight that they were up 819 for the custom period. Now we're up 956. So.
Thank you for paying attention to fire.
No problem.
Absolutely. That's important. Anything else for Kevin or Morgan Stanley? I'll go back.
Yeah, should we?
Talk about the 457.
Yeah, so we do the quarterly reports of all the investment products within the defined contribution plans. So these are the investment options for all the participants in the 401A as well as in the 457. And I just started here, pulled up the summary, which is actually after tab 1. So it's a bit in the very, very back of the this attachment. And here, I can share this with you. I have it up on the screen. So these numbers are outdated compared to what Amy presented earlier in the meeting. She presented as of last month end, and this is as of last quarter end. So we did discuss this. a little bit in the last meeting, and, just to look at the beginning of the year, the 401A was, right about 2.889 million, ended up at, 2.9 million, by the end of the quarter. The 457 started at 5.67 million, ended at just right above 5 million. And, Lorraine made the good, question, why was it such a decrease of, about 600,000? And you can see just in that last, column there, that there were withdrawals of, I think there was 5 participants, but 3 of them quite significant withdrawals. So that was, about, 670,000 that were withdrawn from the plan. So overall combined for the quarter, or the 401A and the 457, started at 8.5 million and then ended at 7.9 million. And then, there is a forfeiture balance, which is used to pay fees on for the plan, for these plans. And so, the forfeiture, the ending balance of the forfeitures is 63,000, which is a nice little kind of amount for the town to have there. And so including the forfeitures, we're at 7,994,000. If you look at the plan summary below with the participants, Amy and her team and I are working on, making her numbers more in line with our numbers. Just has to do with a little bit of a lag and when they input it in the system. But so I would go always with Amy's number. The payroll numbers are 100% correct, and power numbers can be a little bit lagging. And just to show, this is on the next page, if you were to flip it over, the market values over time. And again, this is on the quarterly basis, so there has been a great increase in the market. The decreases again that you see on the far right-hand side reflect not only a more challenging first quarter in terms of market values, but also those decreases or withdrawals from the plans.
I just have a question, just at a high level, from the employees, who's in the 401 and who's in the 457? What's the breakdown, just at a really high level?
So the 401 are all of, as of July 1, 2017. We said that all town employees except for police have to go into the 401A. So that's all active, and people that have left are in that. And then the 457 is anyone that wants to defer compensation can be in the defined benefit plan or the defined contribution plan. I'm in the 457, and I just put money in, and it's, tax-free deferred compensation. Anyone can do it.
Okay, thank you.
And which one has the town match?
401A. And that's why it has a forfeiture balance, because when people leave before they're vested, the amount that the town put in goes into the forfeiture, and then we pay our fees with it.
And a new employee who starts today, do they have an option to do one of these, both of these?
They can do either the defined benefit or the defined contribution, and they're required to pick one depending on their eligibility. So a police officer really is the only one that has a choice between the two. Everybody else is defined contribution. And then they're offered the 457 if they want to put away more.
Thank you.
So for the larger report that we have, that we do on the quarterly basis of all the funds, I'm just gonna, there's a lot of data there. There is very rigorous analysis behind the performance of all the funds available to participants. And really the most important thing is to, here we are, page 4, that just looks at how many participants are choosing the target date funds. And that is about, 44, just over 44%. So that's a really good number. Again, Kevin and I give education to the participants about the advantages of using the target date funds as they become more conservative the closer you get to retirement. I just should make a special note that in the past month, we have reached out to every single, and this is based on or stemmed from a conversation with Carl a couple meetings ago about reaching out to participants more from Morgan Stanley, offering education and really, other ways to get informed about the market, which is, part of the benefits that the town offers to every participant within the plan. So we did send out an email to every participant and explain to them, that we are here for them, explain to them, actually the participants in the room each received that email. And as well as Morgan Stanley is now offering expanded benefits in terms of education, quarterly newsletters about the market, monthly dial-in to listen to education topics. So these are going to be more regular and ongoing communication to the participants. And then getting back to the report, so the reviewing all of the managers, all the strategies available to the participants. There is a monitoring criteria that we use to determine if they are on watch or if they're okay. It is here starts on page 18 and continues on to 19. A very thorough, monitoring of every investment strategy. And to date, we do not. There was one that was on watch for Q1 of 2026, and that was the small cap growth. But that was just on watch for 1 quarter, and it really takes 3 quarters of being on watch for us to really take action. Happy to take any more questions.
Any other questions?
No.
All right, thank you so much for that.
Thank you.
Thank you. And moving on to Leanne's report.
Okay,
He says it's your last one.
this is, yes, so these are, books that we're gonna hand out. The last time we did it was like 5 years ago. And it's a recognition of all the work that you've all done. It's the plan document for the, defined benefit plan, and the fire plan. The investment policy statement is in here, and I know, we're gonna make a couple of changes, but basically it's got good bones. I don't think it's gonna change much over the years. We'll just tweak a few things. We updated the 401A and the 457 plan. The biggest change here was recognition that they can only be in one plan or the other, and that is mandatory. And the investment policy statement for, the 457 plan as well, that outlines things such as how things that go on watch and what Morgan Stanley does to monitor. So that's all a reference, for all of you. And then, as Rowena mentioned, this is my last in-person meeting. Next month, I'm taking him with me too. We're going on a cruise, from Rome to Athens, so we won't be here. But, yeah, and then September 1st, the new finance director will be starting, so she'll be.
Have we identified that person?
We have, but we're not saying
You're not
anything
saying.
because she has not, given her notice, but she's,
Okay.
very excited to be, she just doesn't want it out there yet. She wants to give the benefit to her employer. So, I, just wanted to say goodbye in person. And I also wanted to thank all of you. You're such great volunteers. You give all your time. We have such a great committee here.
Board.
Really, it's a wonderful board, and Morgan Stanley, and it's so professional. You guys have done such a great job. Keep it up because my pension depends on it.
Well, thank you, Leanne, for all of your hard work over the years, and we are so excited to still have part of your group on the board.
Oh, yes,
And
yes, no
we do hope that you get to both enjoy your retirement, well deserved.
Yes,
But we will miss.
And this is great, by the way.
Yes, thank you.
I'll be ready for the test next meeting.
I'll send one out because I won't be here. I'll grade them now.
Oh, shoot. Actually, thinking of sending out, could I trouble, your office for an electronic copy of these final documents?
Sure.
I can move,
Yeah. And I save them and it's easier to.
Tracy, can I get that too, please?
If Lorraine, do you want yours mailed, or Paul, do you want yours mailed? Yeah, Lorraine would like hers mailed for me.
No.
Yeah, just throw it in the mail for Paul, so since he's there. So that's it for me.
Any other business for Leanne or any other business? All right, I think we'll take a motion to adjourn.
So move.
And I'll second.
Okay, all approved or all in favor? Go with God.